What is up, family? Welcome back to the Coders Trade. Guys, we have officially reached day 3 of our free trading course. Look at the screen. We are opening the Forex Dictionary. Open book. Here is the brutal truth. Most beginners lose money not because they are stupid, but because they are illiterate in the language of the market. You press buy, but do you know what a PIP actually is? Do you know why swap is eating your profit overnight? Or what a margin call really means? If you don't know the words, you can't read the story the market is telling you. So today, we're going to fix that. We are going from guessing to professional in just one video. By the end of this session, you will speak fluent hedge fund. So grab your notebooks, sit up straight, and let's master the secret language of the market. Let's dive in. Before we go any further, guys, we need to have a serious talk. Stop what you're doing and look at the screen. If you're an Indian resident, this is the most important slide for you. According to the FEMA Act, Foreign Exchange Management Act, trading currency pairs that don't involve the Indian rupee, like euro to US dollar or pound sterling to Japanese yen, or using unauthorized international brokers is strictly illegal. I see so many people on social media promoting secret international platforms, but listen to your buy. The penalties for violating these regulations can be severe. Your path forward is simple. Use SEBI-registered brokers. Only stick to authorized Indian platforms. Trade compliant pairs. Stick to the instruments allowed by our regulators. Respect the risk. Your capital is always at risk. Don't make it worse by breaking the law. I'm here to make you a pro trader, but a pro trader is a legal trader. Research thoroughly, make wise decisions, and let's build your wealth the right way. Ready? Now that we're safe, let's get into the dictionary. All right, fam, let's get into the first real concept of our dictionary, currency pairs. Unlike the stock market, where you can just go and buy a single company like Apple or Reliance, in Forex, you never trade alone. Think of it as a constant battle, a main event championship happening 24 hours a day, 5 days a week. Whenever you make a trade, you are simultaneously buying one currency and selling another. Look at our boxers on the screen. The base currency. This is the first currency in the pair, like the euro here. The quote currency. This is the second currency, the dollar in this example. When you trade, you are betting on relative strength. If you click buy on euro to US dollar, you're literally putting your money on the euro to outperform and beat the dollar. If the euro gets stronger, you win a round. It's all about which side of the pair has the real power. Easy to understand, right? Let's see how we actually measure that power in our next slide. Now, let's look at the anatomy of a trade so you can finally decode that price tag on your screen. Every pair has two sides. The first currency you see, in this case, the euro, is your base currency. I want you to think of this as the product. Just like a potato in a vegetable market, this is the actual item you're choosing to buy or sell. The second currency, the USD, is your quote currency. This is the money. This is what you use to pay for the product. It quotes the price of the base currency to you. Here is the simple logic to keep in your head. If you click buy on euro to US dollar, you are essentially buying euros and paying for them in dollars. It's exactly like going to a shop. You give quote money to get base product. If you understand this, you've already mastered more than half the traders out there. Ready to see how we categorize these products? Let's move to the next slide. Listen up, guys, because this slide will save your trading account from unnecessary suicide. We're talking about the hierarchy. Just like in Bollywood, there's a list of stars, and you need to know who is who. Majors, the celebrities, these are your A-listers like euro to US dollar and pound sterling to US dollar. They have the highest volume and the lowest spreads costs. If you want a smooth ride, you stay here. Minors, the B-list, these are crosses like euro to pound sterling or Australian dollar to Japanese yen. There is no US dollar here. They have medium spreads and are a bit more jumpy. Exotics, the Wild West, pairs like USD/TRY or US dollar to Mexican peso. Beware, these have crazy spreads and extreme risk. One wrong move here, and your account will vanish. Pro tip for my beginners, stick to the majors. Don't even touch the Wild West until you are consistently profitable. Focus on where the volume is. Ready to see the actual math of how these move? Now, fam, let's look at the actual numbers. When you open your terminal, you'll see a quote like 1.1050. What does this actually mean? It simply tells you that it takes $1.1050 to buy 1 euro. Think of it as the exchange rate you see at the airport. Here is the golden rule to remember. If the price goes up, the base euro is getting stronger and the quote USD is getting weaker. If the price goes down, The base, euro, is getting weaker, and the quote, USD, is getting stronger. Whenever you see a green candle, the first currency in the pair is winning the fight. When you see a red candle, the second currency is winning. Simple as that. In the real world, we measure distance in meters. In Forex, we measure movement in PIPs. It stands for percentage in point, and it is the standard unit to measure price change. For most pairs, a pip is the fourth decimal place. If euro to US dollar moves from 1.1050 to 1.1051, that is a 1 pip change. But watch out for the JPY pairs. The Japanese yen is an exception. For yen pairs, the pip is the second decimal place. Think of pips as your scoreboard. More pips usually mean more profit, but as we'll see soon, how much money each pip is worth depends entirely on your lot size. Next to that fourth decimal, you might see a tiny, dancing fifth number. That is the pipette. Think of it like the change in your pocket. It's a fraction. 10 pipettes make 1 pip. In our rupee terms, if a pip is a rupee, a pipette is like a paise. Who uses it? Mostly micro scalpers who need extreme accuracy. Pro traders targeting 50 or 100 pips usually ignore it. Note, for JPY pairs, while the pip is the second digit, the pipette will be the third decimal digit. Don't let that extra little number distract you from the main trend. Now we're getting into the money-making part, lot sizes. This is how you control your volume or the amount of currency you're trading. Standard lot, 1.00, we call this the whale. You're trading 100,000 units. 1 pip here is worth roughly $10. Mini lot, 0.10, this is the shark. You are trading 10,000 units. 1 pip is worth about $1. Micro lot, 0.01, this is the student. You're trading 1,000 units. 1 pip is only worth $0.10. Always start with 0.01 microlots. Don't try to be a whale on your first day. Protect your capital first, and once you are consistent, then you can level up to become a shark. Ever notice that the moment you enter a trade, you are already in a small loss? No, the broker isn't cheating you. That is the spread. Bid price. This is what the market pays you when you sell. Ask price. This is what you pay the market when you buy. The difference between them is the spread. This is the broker's commission. In the example on screen, the gap is 2 pips. Pro tip, always look for low spread brokers. If the spread is too high, you have to run a long race just to get back to zero. Be smart about your entry costs. All right, guys, let's talk about the biggest advantage of Forex. You can make money even when the market is crashing. Going long, bullish, you believe the base currency will strengthen. It's the classic buy low, sell high strategy. As we say in the markets, the trend is your friend. Going short, bearish, this is the game changer. You believe the base currency will weaken. You sell a high price first and buy it back later at a lower price to pocket the difference. You literally profit when others panic. Whether the market goes up or down, there's always an opportunity to win. You just have to pick the right side of the fight. Now, let's talk about the magic of Forex, leverage. Think of it as a financial booster that gives you total control over large amounts of money using very little of your own. If you have $1,000 and your broker gives you 1:100 leverage, you can control a $100,000 position in the market. It's a superpower that lets small traders play in the big leagues. But listen to your buy. Leverage is a double-edged sword. While it magnifies profits, it also magnifies losses. If you don't manage your risk, high leverage can wipe out your account in seconds. Use it like a pro, not a gambler. There's a huge myth that margin is a fee that the broker steals from you. Wrong. The reality. Margin is simply collateral. Think of it like a security deposit you pay when renting a car. The broker holds this money in a vault to cover potential losses while your trade is running. When you open a trade, the funds are locked. While the position is active, that money stays in the vault. The moment you close the trade, the margin is released back to your balance. You don't lose it. It's just your skin in the game. This is where most beginners get confused. You have 2 numbers on your screen, balance and equity. Balance is history, is static. It only shows the money from trades you have already closed. Equity is reality. It is real-time and dynamic. This is your actual money right now. If you closed all your trades this exact second, this is the amount you would keep. The golden equation. Equity equals balance plus floating profit/loss. Pro tip. Never trade based on your balance gauge. Always watch your equity, because that's the real health of your account. Last concept for this batch. and it's the most important for your survival. Free margin and margin level percent. Free margin. This is your spending power. It's the equity minus the margin already locked up. If this hits 0, you can't open any new trades. Margin level percent. This is your account health bar. It's calculated as equity / used margin x 100. Look at the margin level indicator on screen. Safe zone, greater than 100% you are healthy. Danger zone, near 100% you are entering the margin call zone. Stop out. Red, the broker will start closing your trades automatically to save their money. Keep your health bar in the green, or the market will give you a game over. All right, family, look at the screen carefully because this is the game over slide. We need to talk about how a trader's journey ends if they don't respect risk. First comes a margin call. This is the broker's way of saying, hey, you're running low. It usually happens when your margin level drops below 100%. At this point, you have two choices: close your losing trade yourself or add more funds. If you ignore that warning and your levels drop further, like to 50% or 20%, you hit the stop out. This is the execution phase. The broker will automatically start closing your trades to prevent your account from going into a negative balance. Result? A realized loss and a broken heart. Golden rules for survival. 1. Always use a stop loss. Don't wait for the broker to do it for you. And 2. Keep your lot sizes small. Don't let the broker close your trades. You stay in control. How you enter the market determines your success. Most noobs use machine gun style, but we trade like snipers. Market execution. This is the I want in now button. You buy or sell instantly at whatever the current price is. Great for fast-moving news, but you often get bad pricing. Limit orders. This is the discount strategy. You tell the broker, buy for me only if the price drops to a better, cheaper level. Stop orders. This is the momentum strategy. You tell the broker, if the price breaks this resistance and keeps going, I'm in. Pro tip, don't chase the market. Use limit orders to get better entries and significantly reduce your risk. Think of trading like a sport. You need both a solid defense and a strong offense. Stop loss. The insurance policy. This is a preset order that closes your trade automatically if the market moves against you. It protects your capital from wiping out and removes the hoping emotion. Golden rule. Never enter a trade without an SL. Take profit. The paycheck. This closes your trade when you hit your target. It secures your gains before the market can reverse and teaches you to be disciplined and not greedy. Once you set these levels, set it and forget it. Trust your analysis and let the system do its job. Did you know you can earn interest just for holding a trade? Every day at 5 p.m. Eastern Standard Time, the new year close, a rollover happens. The math is simple. Interest earned, interest paid equals your net profit or loss. Positive swap. If you buy a currency with a high interest rate like 5.5% against one with a low rate like 0.1%, you earn the difference every night. Negative swap. If you're on the wrong side of that interest gap, you pay the difference. Secret tip. On Wednesdays, swaps are usually triple, 3x, to account for the weekend interest. Be aware of these hidden costs or gains when holding trades long-term. Finally, let's talk about the ghost cost of the market. Slippage. Have you ever clicked buy at 50 but got filled at 55? Slippage is the difference between your expected price and the actual execution price. Why does it happen? High volatility. During big news events like NFP, the price jumps too fast for the server to keep up. Low liquidity. There aren't enough buyers/sellers to match your order at your exact price. Happens on holidays. How to fight it? Don't use market execution during chaos. Instead, use limit orders. A limit order guarantees your price, even if it means missing the trade. Better to miss a trade than to enter a bad one. In the market, we don't just say up or down. We talk about beasts. Bullish, rising market. This is characterized by optimism. Think of a bull attacking. It thrusts its horns up into the air. When you see higher highs, HH, and higher lows, HL, the bulls are in charge. Bearish, falling market. This is fueled by pessimism. A bear attacks by swiping its heavy paws down. Lower highs, LH, and lower lows, LL, tell you the bears are winning the battle. Are you going to ride with the bulls or hunt with the bears? Knowing the battle of the beasts helps you align with the current trend. When the big bosses at central banks speak, they sound like birds. Hawkish, like a hawk diving for prey. These bankers are aggressive about stopping inflation. Their primary tool? Raising interest rates. This generally strengthens the currency because it attracts foreign investors seeking higher returns. Dovish, like a peaceful dove, these bankers want to support the economy and keep things calm. They prefer to cut rates to boost employment and spending. However, this often weakens the currency value. Understanding this bird talk gives you the macro bias you need for long-term trades. Forex is open 24/5, but you shouldn't be trading all day. Tokyo. Asian session markets are often slow and ranging. It's the sniper session, good for scalping small moves. London. European session, massive volume enters. Most major trends and breakouts start right here. New York, U.S. session, high-impact news, like NFP, drops here. Expect fast reversals and major USD moves. The golden hour. The magic happens when London and New York are both open. For us in India, that's roughly 6:30 p.m. to 10:30 p.m. IST. This is the golden hour with maximum liquidity. Don't trade hard. Trade smart during the overlap. If you want to stay in this game, you must master the math of survival. Look at the seesaw. You should always aim for a reward that is at least 2x your risk. Check this table. Even if you are wrong half the time, 50% win rate, you still make money. 5 losses at $10 each is minus $50, but 5 wins at $20 each is plus $100. Total result? You're up $50. The golden rule: never risk more than 1% of your account on a single trade. Amateurs focus on how much they can make. Pros focus on how much they can afford to lose. Be a pro. Boom. Class dismissed. You now speak the language of money. Today we covered the logic of pairs, measured movement with pips, understood leverage, and found the best sessions to trade. Don't let this knowledge fade. Download the complete Forex Dictionary cheat sheet right now at TheCodersTrade.in.
Thank you. I hope you understand this, and please don't forget to like, share, and subscribe. I will also appreciate any suggestions in the comment section, and please visit our platform, The Coders Trade, with the link given in description.